quote from our esteemed colleague, George Foreman. Okay, all right, here we go. All right, so the question isn't at what age I want to retire, it's at what income, George Foreman. Okay, not somebody who you'd typically think would be quoting things about retirement, although, you know, he did have quite a career and ultimately did retire, although he boxed until he was like 50-something, I think. Good for him. Anyway, okay. So getting started, welcome again. This is, well, the second in the series, Retirement Income Planning. I'm Michael Graff. Thanks again to the Westwood Library for hosting this event. And again, you know, there's my credentials, you know, chartered financial consultant, chartered tax advisor, you know, Social Security advisor, et cetera, et cetera. A lot of years in financial services, so you can just take a quick look at that, and then we'll move right along, okay? And, you know, obviously, you know, we do have kind of a quick disclosure that I need to read to you, or at least give you the opportunity to read. The main thing here is that we are not affiliated with the federal government. We're not part of the Social Security Administration. And this is not intended as tax or legal advice. Please seek the advice of a qualified financial or legal professional, you know, with any questions or if you want to implement any strategies. I volunteer, okay. From the financial side, not a legal person. But anyway, okay, so moving right along. Okay, so again, if you have a cell phone, make sure it's on silent mode. The restrooms are right in back. And as far as quick questions go, you know, again, you know, kind of a small group. So if you have a question along the lines of kind of a clarification, please feel free to speak up or raise your hand. And, you know, I'll try to answer it quickly. If it's going to be a more involved response, then I'll table it and we'll discuss it at the end of the workshop or offline. You know, certainly happy to speak to people by phone or by appointment. Everybody should have one of these handouts. It has a lot of great information in there. And also, if you do have some requests for additional information or specific questions about your situation and you'd like to talk to me again offline, feel free to go to that URL there, planning-meeting.com. It'll bring you right to my calendar, and you can set up a time for us to talk. Okay. Again, this is second in a series. I did Social Security last week, following up with retirement income planning this evening. Okay, I don't know if anybody has heard of Robert Kiyosaki. He's kind of an interesting guy, big real estate guy. You know, again, if you follow him, then you know he does the Rich Dad, Poor Dad series. Anyway, but I like this quote: "A wealthy person is simply someone who has learned how to make money when they're not working," which is really what we're talking about when you retire. Okay, so there you go. Very to the point. All right, so question. Very, very simple question. When can you retire? Simple answer. When your passive income is enough to cover your expenses for the rest of your life. Okay? Simple question, simple answer. A little more complicated than that, but there you go. Try to simplify it as much as we can. So let's really draw a distinction between passive income and what you would refer to as active income. Now, active income is where that's what you've been doing for all the years, you know, from the time you got your first job until you retire, is you're exchanging your time, your labor, and your expertise for a paycheck. That's active income, okay? Passive income is income that you derive without effort, okay, to use that terminology. In other words, it doesn't require your intervention, your involvement. So active income, if you look at it again more simply, is you working for money. All right? Passive income is money working for you. Retirement planning is the process of replacing active income with passive income in a sufficient amount to cover your living expenses. So that's what you're doing, is when you're thinking about retirement, you're going, okay, I've given up my paycheck, my active income, I got to replace it, or at least a percentage of it. Which brings me to this concept here, income replacement ratio. So when you're retiring, you're giving up your paycheck. You have to replace it with passive income. So the question is, how much passive income do you need? Well, this is where this sort of income replacement ratio comes in. What percentage of your active income do you need in retirement? Generally speaking, you know, you probably won't need to replace 100% of your income, although it may feel that way. But generally speaking, you might need a percentage, maybe 80%, 60%, really depends on your circumstances. But again, the more you're making during your active earnings years, probably the lower the percentages. But just keep in mind that concept of, the replacement ratio. Okay. So again, how much do you need? Well, it could either be a number. You might say, well, I need X amount of dollars to live on when I retire, or maybe it's a percentage, 60 or 80%, like I was just saying. It has to cover housing, health care, transportation, groceries, personal care stuff, together with the discretionary expenses. Money, living expenses, money that that you have to spend versus money that you want to spend, discretionary expenses. So again, what is that amount that you need to cover those things? And that's what you're going to need for passive income in retirement. So what are the sources? Well, here are the general sources of passive income, and we're going to go through each one of these individually and just discuss them more in a little bit more detail, a little bit more depth. Starting with Social Security. Now, as I said last week, Social Security is really that foundation of your retirement income. It's kind of like where you start, all right? And it's guaranteed. The federal government guarantees Social Security, and to the extent that we can depend on the government, and I think we can, at least for us baby boomers, then it's a good, reliable, future income stream. It's going to replace a percentage of your active income. Depending on your situation, anywhere from 30 to 40, maybe as much as 70%. It's not going to replace everything. You can't, generally speaking, you can't live on Social Security. Most people can't. But again, it's that foundational piece. You can claim it starting at age 62, up to age 70. Those are and again, we get into more of that. Actually, we got into a lot of that last week. And then the spousal and survivor benefit considerations. Again, if you're part of a married couple, there are considerations for spousal, coordination. Again, coordinating your Social Security with the spouse, assuming that they, that they have it as well, and generally they will. And then also survivor benefits. And then there's the cost of living adjustments. So these are the main features of Social Security. Clearly, this is just a very quick overview. Social Security really should be dissected and really scrutinized as part of your retirement planning process. But just to give you, again, a quick overview. Okay, now moving on to pensions. Now, pensions used to be very common, very prevalent. Not so much anymore. I'm not even going to get into all the details of that. But pensions, defined benefit plans have been supplanted by defined contribution plans, IRAs, 401ks, 403bs, et cetera, over the past, 20, 30, 40 years. So not that many people have pensions anymore, but they still are out there, and actually people are still earning them, again, to a lesser degree than they used to. But the thing to be aware of with pensions is, are they reliable? Now, pensions come from the federal government. They come from state, municipal governments. They also come from private enterprises, from companies, corporations. So to the extent that you have a pension, you want to make sure that it is the funding source can manage to maintain it over time. There are circumstances where pensions have gone belly up. Doesn't happen a lot, and there is this organization, the Pension Benefit Guaranty Corporation, which just, to a large extent will guarantee pensions, not all of them, but some of them. But if you have a private pension or a public pension, just be aware, and this is older information, this is actually 10 years ago, but it does sort of, kind of state it very starkly. About 80% of the 29,000 private sector defined benefit plans, pensions, insured by the Federal Pension Benefit Guaranty Corporation have been underfunded by $740 billion. That's 10 years ago. It hasn't gotten better. It's gotten worse. So that number has clearly gone up since then. So I'm not saying that you have if you have a pension, I'm not saying you have a problem with it, but verify it. Make sure that the pension is well-funded, preferably fully funded. This is something that I do for my clients if they do have a pension, all right? But if you do have a pension, hopefully, and it's fully funded, then it's a great source, again, of guaranteed, reliable income for the rest of your life, for the most part. Okay, moving on to distributions. All right, so when we talk about distributions, really talking about money that you're taking out of, systematically taking out of your, your investments and your retirement savings accounts. Now, there's this concept called withdrawal rate. Yeah, in other words, how much can you safely withdraw from an account in order so that account remains liquid or it remains viable? So again, what is the quote-unquote safe withdrawal rate? Now, there's this rule, the 4% rule. It came out of some studies that were published back in the 1990s. But the 4% rule stated that you could withdraw 4% out of your retirement account, and the account would still remain viable. In other words, you pull 4% out, it would be gaining 4%, based on conservative investing, and it would remain viable. In other words, basically remain at even. When interest rates dropped, starting really in the early part of the millennium, that became more problematic. In other words, the safe withdrawal rate really wasn't 4% anymore. Interest rates are going back up now, so we might be recovering some of that at this point. But the question really still looms is that what is the safe withdrawal rate? In other words, if you've got a chunk of money, how much can you safely withdraw so that it will last as long as you need it to last as part of your overall retirement income, your retirement income strategy? Again, is it viable? Is it practical? This is all part of the planning process. Now, there are different types of rates of return. You've got variable. In other words, like if you have money in the stock market doesn't give you a guaranteed set rate of return. It's variable. The stock market's up, stock market's down. So you're getting a variable return on your money. Banks typically will give you a fixed rate of return, a reliable, predictable return on your money. Banks and bonds typically. Then you've got this concept called total return, which is a combination of the capital appreciation, in other words, the appreciation of whatever investment you have, together with the return, whether it's interest or dividends, and you combine those, and that's what's called total return. Then you have average, the average rate of return. That's something I want to spend a little bit more time talking about. For the people that just came in, there's a couple of booklets on the back table there if you want to grab one. Okay. So moving into a discussion of average rate of return. There's something called sequence of returns. Now, this is a little bit confusing, so I'm gonna try to explain it as well as I can. But sequence of returns is very important when it comes to designing a distribution strategy. All right, so this is the S&P 500, including dividends, from 2000 up to 2020, 20 or 21-year period there. These are those are the actual returns, including dividends, during that, couple of decade period, all right? Now, the average rate of return for that period was 8.6%. Now, if you invert that, let's say you mix those numbers up. What do you think the average rate of return will be then? Trick question. It's still 8.6%. It doesn't matter how you mix those numbers up. It's still the same average rate of return, okay? It's math, all right? Now, the point here is that during the time that you're accumulating your money, that you're saving your money and it's growing, the average rate of return doesn't really matter, okay? All right, so now let's look at it from a distribution perspective. All right, so now we're no longer saving money. Now we've retired, and we're actually going to start taking money out. So let's just use a very simple distribution strategy. Let's say we have $100,000. We want to pull out $5,000 per year, okay? So we're going to do the same thing, but what we're going to do is we're going to start at the top, 2020, and we're going to start, and we're going to assume, we're going to predict with our crystal ball the future, and we're going to say that the rates of return are going to be starting at 18.4, 31.49, all the way down, okay? So you can see, if my pointer works here, no, it doesn't, but anyway, that you see that first year, 18.4, you took out, you had 100,000, you took out 5,000, and you ended up with 113.4, okay? The next year, you took out your 5,000, you had the return of almost, well, 31 and change, ended up at 144, and so on, all the way down until the 20 or 21st year, where you ended up with 238, almost $239,000. So you started with 100,000, you pulled out $5,000 per year, and you ended up with almost $39,000. Okay? Now, let's mix it up. I'm just going to invert it. And this is actually what happened. Starting in 2000, remember that? The dot-com bubble, all that, you know, September 11th, which really caused the stock market some problems. We had 3 very negative years there. So here's what happened. Your 100,000 plus the 5,000 you took for income reduced that 100,000 down to 85.9. The next year it went down to 70,000 and change. Next year after that, see that negative 22%, went down to 50,000, okay? Then then we had some good years, so 28, 10, almost 11, et cetera, et cetera. But look what happened after that 20-year period, 21-year period. You only ended up with a little over $40,000. Now, the average rate of return was still 8.6% for both time periods. But because of the, again, it's math, because of how the sequence of the variable returns occurred, it didn't work as well. So the point here is that when you're designing a distribution strategy and you're utilizing something like stock market investments, which could be IRAs, 401ks, et cetera, be aware that the sequence of those returns, because it's variable, not fixed, could be detrimental over a long period of time, a long, retirement period. So again, just be aware of sequence of returns. Okay. I hope I explained that well so that it was really reasonably clear. Okay. All right. Okay. The point here is that, during distribution, sequence of returns really does matter, okay, as opposed to during accumulation. Okay. Now, there's also another concept I want to just quickly discuss called recovery rate of return. So here's kind of an extreme example. 2008, we all know, 2008, bad year for the stock market. Including dividends, the S&P 500 was down 37%. So how much return would it require the next year in order to recover what you lost? Now, you might think, well, 37%, but it's not the case. Because the way it works is you actually need 59% to get back what you lost because you're starting with a lower number, okay? So you need a greater percentage because the money that's remaining in that account, it's not 100,000 anymore. Now, in this case, it's 86.3 in order to get back, your money. So when you've lost money, you need a greater return in order to recover it, okay? So just recovery rate of return. Okay, timing. Okay, this is also very important, the timing of when you retire. Okay, so again, same distribution method, 100,000 is what we're starting. That's our principal, and we're going to pull $5,000 out per year. Okay, so here's our two couples. We've got Barney and Betty, and we've got Fred and Wilma. Now, Barney, let's face it, Barney, he was always a little smarter than Fred, right? Fred, let's face it, Fred was a little screw loose. Barney always seemed to me to be a smarter kind of a guy. So Barney was a little smarter with his money. And so he was actually able to retire a little earlier. So he retired in 1995. Now, we all remember the late, 90s. Things were great. These are actual numbers here. That's what the S&P 500 was returning during the 5 years at the end of the 90s there. Was tremendous, okay? So, he pulled out his 5,000, starting with 100, and at the end of that 5-year period, Barney had $309,000. That was a great time to retire, right? Fred, on the other hand, not being as smart as Barney with money, he had to wait another 5 years to retire, so he retired in 2000. Not as good a time to retire, as it turns out, because that was when the dot-com bubble burst, and again, September 11th, so we had those negative years. So same exact thing, 100,000, pulled out 5,000 per year, ended up with only close to 61,000. So the timing of when you retire can be also, let's just say, impactful on your money. So you sort of have to ask yourself this question: do I feel lucky? In other words, when I retire, is the stock market going to be my friend or my foe? So anyway, okay. Okay, moving on to dividends. Okay, so a dividend is a distribution. It's of profits by a corporation to its shareholders or some entity, typically corporation. Any amount not distributed can be reinvested. So you can take your dividends either as take them as cash, or income, or you can just reinvest them typically. So whatever. But all right, so you've got different types. You've got you can take it as cash. You can take it as stock. You can, in some cases, take it as property or a hybrid combination of things. And you get them from corporations, public or private, REITs, real estate investment trusts, master limited partnerships. These are your typical entities where you can derive dividends. So here's an example, okay? Obviously a company everybody's familiar with, IBM. And actually I took the share price just yesterday. It was trading at the close of business, 147.41 was the share price. The annual dividend, $6.60. The dividend yield, 4.44, okay, so good dividend yield. The payout ratio, that's the amount that the company pays out in relationship to their profits. So that's a fairly high payout ratio, but IBM is a very mature company, so clearly they've gotten to the point where they can afford to pay out a higher percentage of their profits and still remain, in good financial shape. Not a lot of companies can do that. That's a fairly high payout ratio, but again, IBM can manage that. Years of consecutive dividend increases, 28 years. This is obviously a great company, growing dividends, very stable, very reliable. They issue their dividends quarterly. So again, just an example of a dividend-paying security. There's a lot of companies like this, in the market. But again, just to give you some, a specific example. Okay, moving on to interest. All right, so, and banks and bonds. So bank interest is safe, all right? So that's great. You put your money in the bank and you get interest. Now, until recently, the interest you got from banks was pretty pathetic. It was terrible, right? It's getting a little better, obviously, interest rates are going up a bit now. You can actually see some CD rates that are better than pathetic, We'll see how that trends. But anyway, they're still lower. But in any case, it's at least a safe return. And you've got a lot of, now bonds, I could do a whole workshop on bonds. So I'm not going to get into, anything in depth here, except that bonds, basically what you're doing with a bond is you're lending money to the entity, and they're promising to pay it back to you. You've got, obviously, the federal government, you've got state and local governments, you've got international bonds, private, corporate, high yield, what used to be referred to as junk bonds, now they're called high yield bonds. Although, there can be some, some opportunity even there. And then you've got your different durations of bonds, shorter duration bonds, which offer lower returns, but you're not locked into them for that long. And then you've got your mid-range and longer-range bonds. Bonds are more problematic than they used to be. It used to be that you could really moderate risk in a portfolio by increasing your bond holdings. With the way interest rates are trending, that hasn't been as good a strategy recently. That's not to say bonds are still not a good way to go, because they very well can be. But again, you just have to kind of look at them a little bit differently. But again, as part of a way to generate income in retirement, bonds can be something to seriously consider. Okay. Then you've got annuities. All right, now, how many people here have a favorable viewpoint on annuities? I'm just curious. Favorable? Yeah? How many people have a negative viewpoint. Okay, all right. Yeah, so again, annuities probably, I mean, although most financial instruments, to one degree or another, are complicated and difficult to understand, annuities take that to a whole new level. Annuities are a very complicated product and very difficult to understand. That's not to say that they're not good. They can be excellent, okay? Also, they can be very ineffective or very poor. Now, I'm not going to go into an in-depth discussion of each of these types of annuities. You've got immediate annuities. That's where and by the way, annuities are a life insurance company product. They're only available through life insurance companies. So again, an immediate annuity is one where you exchange an amount of money with a life insurance company and you get a guaranteed rate of, you get a guaranteed stream of income in return for that. And again, can be a very effective way to create a guaranteed stream of income in retirement. You've got deferred annuities. That's a way to give money to a life insurance company, let them manage it, grow it, and then give it back to you at some point in the future. You can either give them a lump sum or you can give it to them incrementally, and then they'll give it back to you at some agreed upon time in the future. Then you've got fixed annuities. Now, a basic fixed annuity acts a lot like a CD. Or you've got, then you've got indexed annuities. Again, how is the annuity being, how is it growing? What's its underlying, how is it getting underlying gains, all right? So what's its underlying investment? Typical fixed annuities usually rely on the general fund of the life insurance company. Others rely on a variety of different types of stock market indexes. But again, fixed annuities can be a great way to go to safeguard money or to create guaranteed streams of income. There's also some other features which I won't go into. And then variable annuities, again, a more complicated type of thing. It invests in stock market securities more directly, a little bit more risk to principal with certain types of variable annuities. But again, they could have their positive features as well. The main thing to think about with annuities is guaranteed income, together with options for principal protection. Annuities oftentimes are used to protect your principal from stock market risk, just the way maybe a bank product would, but there's ways that annuities could actually give you better rates of return potentially, whereas maybe a bank product wouldn't do that, or a bond product might not do that. Again, complicated, you need to really delve into it to get the details. Annuities, however, can restrict your access to the money. So either limited access or even potentially no access for a period of time. So again, it's all part of looking at what your ultimate objectives are and deciding whether or not this type of product is appropriate. Okay? It can be very appropriate or not so. Also, fees on annuities can range from 0 to, in some cases, the fees on annuities can be very high, and frankly, rendering the product, in my opinion, not viable. In some cases, some of these annuities can have fees ranging upwards of 3, 4, even 5%. That's rare, but again, be on your guard for annuities and what the fees might be. Okay, then you've got real estate. Now, real estate actually is a great thing right now because real estate's a nice inflation hedge investment. But in any case, you could own property and get rental income. There's real estate investment trust. That's a way to invest in real estate less directly, but still get a lot of the benefits. Then reverse mortgages. I know reverse mortgages, that's another one of those products that oftentimes is not thought of favorably, but it could possibly have its place in a person's overall retirement income strategy. And then finally, life insurance. Now, life insurance can be a great product. There are some people, some financial professionals out there that are touting life insurance as a way to create retirement income, and that can be very effective. I'm not as up on that strategy for people who are entering or investing in the product later in life. I think it's more effective for people that are, deploying or utilizing that strategy as younger people. But again, life insurance can serve some valuable purposes in retirement. Income, estate creation, covering, final expense costs, et cetera, et cetera. But as a retirement income strategy for people that are already 50, 55, 60 plus, I'm not as, I'm not much of an advocate of that part of it. If you're starting it younger, then yes. But to get into it like that at an older age, I'm not I don't favor that as much. In any case, okay. So now that we've gone through the typical sources of retirement income, then the big question comes up, sequencing. In other words, okay, so I've got these different retirement resources, Social Security, a pension maybe, an IRA, maybe an annuity or something like that. What's the best way to kind of put all that together, sequence it in such a way that it will create that retirement income that I'm looking for? In other words, how much income do I need in retirement? How much am I trying to replace from my active income? So what's the best way to do that? Okay, so, sequencing, distributions, that type of thing. Okay. So, for example, should you take Social Security at 62 or should you wait? That's always a big question. People ask me that all the time. Mike, I've got Social Security. Should I take it, here or should I wait? What's the right answer? And a lot of it has to do with, like, for example, take higher distributions from your IRAs earlier, okay, maybe from 62 through 66 or something like that, or 70. Take higher distributions, and then when you do trigger Social Security, then you can lower your distributions later. So again, different ways to kind of fit together the different pieces of your retirement income, okay? So what you want to try to do is create a passive income that is inflation resistant, tax efficient, and obviously, properly sequenced. And finally, as much as you can guarantee it, you want it to be guaranteed. Okay? And again, different types of incomes are going to be a little bit more reliable, more guaranteed than others. But this is really what you're trying to do.
Can I ask a
Yeah,
question?
please, yeah.
I'm sorry, based on our discussion last week,
Yes.
I was under the impression that basically you're never going to get any more from Social Security than you will at 67. But you've mentioned 70 a couple of times.
Right, okay, well, no, you actually, all right, so if you're full retirement age, if you're born after 1960, then your full retirement age is 67. At 67, you will receive 100% of your primary insurance amount. But if you wait, let's say you decide, okay, I'm not going to take my Social Security at 67, I'm going to wait. You'll get 8% more if you claim it at 68. And then if you claim it at 69, you'll get 8% more on top of that. If you wait till 70, you'll actually get 8% more. You get 24% more. So the idea is if you wait, you're getting, I guess you might think of it as a guaranteed return of 8% on your income if you wait to take Social Security. It grows up to age 70. It does not grow past age 70, so clearly you would claim it at 70. There's no benefit to waiting till later. The idea is if your full retirement age is 67 and you claim it before that, you're going to take a reduced amount of Social Security. But if you wait after age 67 up to 70, you'll get an enhanced amount. Okay, yeah. I'm sorry, I should have been more clear about that at the last presentation. Okay, you become financially free when your passive income exceeds your expenses. Again, I sort of said that earlier, but just to restate it. Okay, so there's this concept. When you're planning for retirement, there are these different phases, if you will, of your retirement. Call them the go-go years, slow-go, and then no-go years. So when you first retire, you've been waiting, and you've been wanting to do stuff, and you've been working all these years. So you want to go, go, go. So you're going to do a lot of traveling, you're going to do hobbies, you're going to buy stuff, whatever you're going to do. So really, maybe for that first 5 to 10 to 12, maybe 15 years of retirement, you're really going to be going, probably spending more money, right? Then you're going to, once you've kind of, checked off a bunch of stuff off your, your retirement bucket list, and you're getting a little more tired, et cetera, and you kind of slow down a little bit. So maybe spending a little less money, but maybe spending a little bit more money on healthcare stuff, unfortunately. And then finally, the no-go years where you're really slowing down, and we won't even really talk too much about that. But again, just keep in mind that when you're planning retirement, planning your retirement income, there's going to be these phases where you're going to be spending money in different areas. Like, for example, in the go-go years, more money spent on discretionary expenses, maybe not as much in health care, but maybe in your slow-go years, maybe less on discretionary, but a little bit more in health care. And then, maybe no-go years, maybe that's where there's long-term care need, that type of thing. So as you're planning your retirement income, you sort of keep in mind that your lifestyle is going to change as you phase through retirement. Okay, so that's really the point I wanted to make here. Okay, so building a plan. So what are the steps? Well, very simply, first of all, know how much income you're going to need in retirement. We'll talk a little bit more about that. Know where your income is going to be coming from. Again, what are your particular retirement income resources? Know what the risks are. What can be a problem? What can, what can derail your plan? Basically. And then know how cash flow ultimately is going to impact your plan. In other words, dollars in from your various passive income sources, dollars flowing out to cover expenses, how that flow of dollars in and out is ultimately going to impact your various resources, your savings, if you will. So again, cash flow, a very important consideration, which I'll talk about in a second. So how much income are you going to need? Well, again, we talked about this last week and actually earlier today. You're going to need to replace a percentage of your active income. In other words, the income you were earning during your working years. When you retire, you have to figure out how much of that you need to replace. 60%, 80%, whatever that number is. To cover living expenses, as indicated here, and also discretionary expenses. And again, go-go, slow-go, no-go, all that. So is it a number? Is it a percentage? Higher, lower? Very important to try to nail this number down. This is something that I work, when I'm working with my clients on designing a plan, I work very hard in this area, and I suggest that my clients work very hard in this area. It's actually one of those, a lot of people spend a great deal of time worrying about the stock market investments, as well they should, but there should be also a great deal of attention paid to cash flow considerations. So there you go. I said it. Cash flow is important as well as investments, all that. Okay. Okay. Conduct a review and analysis of what you're spending. So let's talk about that a little bit. How much and where are you spending your money? Now, a couple of different ways you can do this. One way is you can kind of go through all your statements. If you're like me, my wife and I, we probably spend money through, there's 3, 4 different accounts that we use, debit card, couple of credit cards, that type of thing. So in order for us to really understand what we're spending, we'd have to pull all that information from those three or 4 accounts together. And, that's complicated. There's a lot of work involved there. Or you can use software. And, I actually have some software I give to my clients, which really does this. It automates the process. And actually, this is kind of what it looks like without getting into all the details, but it helps people to understand not only how much they're spending on a monthly or periodic basis, but it also helps them to understand where they're spending money. So the amount and where they're spending, it enables them to be more knowledgeable about their cash flow and ultimately make, better spending decisions, although I like to think people are making good decisions to begin with, but this might help to, help you to tweak things and be more efficient. And this is kind of what it looks like. So for example, all right, so you look at a time period. Again, part of what we're doing when you're building a plan is you build a plan based on what you know today, all right, and what you can reasonably anticipate will happen in the future. So we're building a plan, and then we project it. We build projections. We don't rely on the projections over long periods of time because we're constantly updating the plan. But we build a plan today, and then we say, okay, so you've got your cash inflows, all right? So, and again, you can click into this. Obviously, this is a static presentation, so I can't do it. But you look at inflows, distributions, all that. So you've got, and then you've got your outflows. So dollars in, dollars going out to cover expenses, goals, taxes, savings, all that. And that ultimately leads to net flows, net cash flows. Now, in other words, negatives or positives. So if you have a negative cash flow, then you've got to pull the money out of some type of savings account in order to cover that. If you have a positive cash flow, then you can actually add to your savings. But then what you need to think about is how does that, cash flow impact things over time? For example, your net worth. So again, we're projecting here 2023 down 10 years is showing here, again, just for the presentation purposes. But you see net worth. How is net worth trending? It's actually staying fairly consistent in this particular model. But you've got non-qualified, qualified assets. You've got real estate, mortgages, loans. Again, all the components that make up your net worth. Then you've got invested assets. We look at that as well, and we say, okay, we start with $1 million, and at the end of the year, after we add some money, plan distributions, negative cash flows, portfolio return extent, we expect to get some return on our investment. At the end of the year, we have a little less than we started with, but we're still okay. And you see how it's trending over time. It's actually going down a little bit. But part of what you're doing is when you build a plan, the way you assess whether or not you've built a viable plan is based on how it's projected, how it's projecting. If you build a plan that has you running out of money, when you're 78 years old and you feel like you're going to live until you're 90 or 95, well, that's not a good plan. You have to then go back to the drawing board and rebuild the plan. On the other hand, if it projects well, then you say, okay, good, it's a good plan. We're okay. We still have money when we're, plan to sort of depart this earth. So that's a good plan. Now, clearly, projections, you're not going to just make a plan and that's it. You're going to continually update that plan quarterly and annually in order to make sure it's still viable as circumstances change. So, but again, just to kind of give an example of the process of building a plan. And again, net cash flows, again, we're showing, taxable, all that. Again, it all comes in to where we have, and then we're looking at what the expenses are. Living expenses, housing, debt, health care, insurance premiums, total expenses. Again, dollars in from your passive income sources and dollars flowing out, and how does all of that project? Very important that you have a way to build a plan and see it over, how it functions over time. Most people don't do this, but it should be done. Okay. Okay. And again, budgeting, that's just a screenshot of kind of what the system looks like. All my clients have this system, so anyway, or they have access to it. Okay. And again, you can actually customize it. Like I have, if you have pets or hobbies or something that you want to include there as a particular custom expense, you can put that in there. So you can customize it to meet your particular needs. Okay, so where is your income going to come from? Well, again, those are all the different sources we talked about. I didn't talk about wages. A lot of people do continue working in retirement. So wages is another thing. It's not really passive income, but a lot of people will continue to work, just to, for activity or a little extra income if they want. But so let's say, all right, so let's say, your situation is you're going to get income from Social Security, a pension, dividends, and interest. Or maybe your situation is more like this, Social Security, dividends, and an annuity. Maybe you're more like this, Social Security, annuity, and wages, okay? Or maybe this is what your plan looks like, Social Security, distributions, interest, and real estate, okay? Again, depending who you are, you'll check different boxes. So what are the risks? Well, inflation. Obviously, we're hearing a lot about inflation. 2 or 3 years ago, inflation was no big deal, okay? All of a sudden, it's a huge deal. And will continue to be. Well, we can talk a little bit more about that. Taxes. Taxes is going to take a big bite out of your retirement, nest egg and income. Longevity. Longevity is one of those things, look, you want to live as long as you can, as long as you've got a good quality of life. That's kind of my feeling about it. But longevity, like with our parents and grandparents, typically they lived, 12, 15, maybe 17, 18 years in retirement. Our generation, the baby boomers and following generations, are going to live decades in retirement, 25, 35 years or more. Most people, if you retire in your early to mid-60s and you're living 30 years, think about that for a second. You've got to make everything you've saved last for like decades. It's not like with like my dad, he had a pension, paid off house, he saved some money, he was good, and he and my mother, they had plenty, but their life expectancy wasn't anywhere near what ours is going to be. So longevity is an issue, has to be considered. Unplanned expenses and unplanned risks, again, you have to plan for, things that you don't even expect, or at least contingencies. So let's talk a little bit about inflation. Now, we already know inflation is higher, and we know that the stated objective of the Federal Reserve is to bring inflation back to 2.5%. How many people here think inflation's going back to 2.5%? Yeah, good. You're right. I should have. Let's put it this way. Okay, in the next 5 years. Well, see exactly. I think that inflation will moderate. That's just my opinion. But to get back to 2.5%, I think that's pushing it. Now, inflation is a problem for people, in terms of planning for retirement. Something you should take extremely seriously. Now, what it's going to do over time, we have to wait and see. But let's put it this way. I hope inflation gets back to 2.5%. I'm hoping. Keep my fingers crossed. I hope. But do I actually expect it? Probably not. Am I recommending that you plan for that? No. Do not plan on inflation going back to 2 to 2.5%. Plan on something different. We're not going to talk about that tonight. But again, inflation, something to be taken very seriously. Okay. How will each income source, again, talking about this, be diminished by inflation? Think about the different income sources you have. Like, for example, Social Security. There is a cost of living adjustment feature on Social Security. It historically has not kept up with real inflation, but at least there is an aspect of Social Security that will adjust with inflation. So will it keep up with real inflation? I'm not going to really comment too much on that, but at least it does adjust. Pensions. Now, my father had a pension. He worked, in the pharmaceutical industry, had a pension. It was a static pension. My father enjoyed that pension, or my father and mother enjoyed it, and then when he passed away, my mother continued. She got 90% of it. But it was a static amount of money. It never changed over the 32 years, that both my mother and father enjoyed that pension. It never changed, except when it went down after my father passed away. So again, that was inflation. That was not inflation resistant at all. Distributions from retirement accounts, again, if you're talking about sequence of returns, if you're pulling out a set amount of money, maybe you're pulling out $5,000 this year, but next year you want to pull out $5,500. Year after that you want to pull out $6,000, maybe after that $6,500. The idea is to understand how your retirement resources, your income sources, are going to respond to inflation. Because sometimes they won't. Okay. And this is just kind of a grid right here. If inflation trends at 7%, if you have a $50,000 and change income now, in order to have the same purchasing power, 30 years from now or so, you've got to have $400,000. Okay. If it's 5%, it's got to go up to, what are we looking at there, $240,000. If it's only 3%, then it has to go up much less. But again, keep in mind, in order to maintain purchasing power, you've got to have an increasing income. All right, how will each of your income sources be taxed? Think about that. Social Security, annuities, dividends, how are all those things going to be taxed? if you build a plan properly, then you can, based on current tax law, you can project taxation. Okay, income taxes. So let's kind of look at this. All right, so federal income tax takes a bite, state, although some states don't have state income tax, but in Massachusetts we do. Capital gains taxes, Social Security taxes. You've got other types of taxes, plenty of other taxes, leaving you with what's left over. Again, taxes, unfortunately, is another problem that we deal with in retirement. Okay. Well, we deal with it all the time, let's face it. But anyway, okay. Which sources could actually run out? Now, Social Security won't run out. I mean, in theory, 2034, I think it is. If they don't do anything, then it'll drop. You lose about 20% of it. But I think they'll, quote unquote, fix it before then. But again, if you have stock market investments, that sequence of returns thing, if you don't manage that properly, could that run out potentially? An annuity, I mean, in theory, those don't run out if you leverage them properly. Wages, I mean, a lot of people will start working in retirement, but then, you can't work forever. So maybe you can work for 5 to 10 years, but there's a point where you probably can't work anymore, either because you just don't want to, or maybe health-wise you can't, So wages is not necessarily something that you can count on. But again, are there things that you're relying on earlier in retirement that could run out? Give that some thought. Okay, and again, people living longer in retirement, we talked about this. I won't spend a lot of time on this other than to say if you live to be age 65, then you're going to live into your 80s, and if you're a part of a couple, one of you is going to live into your 90s. And the way medical technology is going, let's face it, I mean, we're going to be living longer and longer. Stuff that killed people 20, 30 years ago is not killing them now. So people are living and better quality of life, that kind of thing, which is great, but you got to stretch, you got to have money too. So, it's great to be healthy, but you also want to have money, at the same time. So, okay. Which sources are vulnerable to stock market volatility and interest rate fluctuations? Again, look at your different sources and say, how are they potentially impacted by these things? Understand, and this is, again, I said this last week at the Social Security workshop, I'll say it again. Understand that if you are part of a married couple, at the point where the first one of you passes away, you're going to lose the lower Social Security income, which means the household is going to take a big hit, 20%, 30%, 40%, whatever that number is. But be aware of that and plan accordingly. If you don't want to take a risk, like I've thought about that with myself and my wife. I think, all right, well, at some point, I'm the higher, the higher wage earner. At the point where I pass away, assuming I'm the guy and she outlives me, then she will lose her Social Security. She'll retain mine, but she'll lose hers. Now, we don't, hopefully, we're going to live long, happy, healthy lives, so this might not happen, hopefully, for 30 or 40 years. But when it does happen, does she want to deal with that? How is that going to be managed? So just be aware of that. Okay, so wheel of worry, concerns, risks. Okay, again, market risk, unexplained expenses, sequence of returns. We talked about that, loss of a spouse, health expenses, forced retirement, all those kinds of things. Spin the wheel. Okay. So again, just kind of recapping those steps, know how much income you're going to need in retirement, know where it's going to come from, understand the risks with each of those income sources, and again, understand cash flow. Understand how that flow of dollars in and out is ultimately going to impact your net worth, your invested assets, et cetera, throughout your retirement years. How is that projecting? 6 reasons that retirement savings plans fail. Well, the first one is savers underestimate inflation. We just talked about that. Over-reliance on Social Security. Failure to calculate living expenses. And just to kind of back up on that one, again, this is where people just don't pay enough attention to cash flow. I mean, I've had people come in. I have people come in my office on a regular basis, and one of the first questions I ask people is, well, what's your nut? How much do you need to live on? How much are you spending? And they go, oh, I think I'm spending $3,000 a month. We go, okay, great, good. Yeah, write it down. We build a plan, whatever. But when we actually test it out, a lot of times it's not 3,000, it's 4,000 or 5,000. And people go, oh my God, I had no idea I was spending that much money. You know, easy come, easy go, you know, kind of a thing. So, you know, so if you fail to understand how much you're spending, and that continues for year upon year, you know, and you wake up and you're 78 years old and you go, man, I'm about to run out of money. What happened? You know, it's because, well, I was spending more than I realized I was spending, you know. So this is why the whole cash flow thing is really important within the context of retirement planning and frankly, managing your finances throughout retirement. The lure of early retirement, you know, people want to retire. I get it, you know. But, you know, make sure that when you're retiring, you've got a plan that works, you know. It's not just, hey, I'm 65, I'm going to retire now. It's like, I'm 65, but do I have a plan that's going to work? Have I built a plan? Have I looked at it? Is it projecting well? You know, okay. Understand longevity expectations. Again, how long are you likely to live? You're probably going to live longer than you think. And the illusion of wealth. Sometimes people think that I've got this money, you know, it's more than, you know, it looks like a lot of money, but maybe in the end it's not as much as you thought. Okay, so that, you know, those are the reasons based on this article right there. Okay, so if we only had a plan, okay, sort of over the rainbow. Again, you know, how do you build a plan? It's not an easy thing to do. It's very complicated, all right? I mean, it sounds easy. I mean, I did the steps for you. Here's what you do, but doing it is another thing. So having a plan, implementing that plan, and then maintaining it as you go. And one of the things I do want to offer everybody is a complimentary copy of my book. It's very readable. It's actually, I wrote it to be kind of short and sweet. Logical and sequential approach to planning your retirement. It's about my 6 steps retirement planning process. You know, go to this website, 6stepsbook.com. Very easy. Put in your name and address, and I will send it to you, and you'll get it in the mail, and it's a good read. You know, anyway, a little self-promotion there, but it really is a good read. I've gotten some good feedback. Okay, your retirement income must be predictable. In other words, you need to know where it's coming from. It needs to be sufficient. It's got to cover your expenses. And it has to be sustainable. It's got to last as long as you're going to last, right? So the best outcome of this whole process of planning is income. Now, I say that because, all right, so a lot of people think about retirement and think about, all right, I want to grow my money. I get it. Put your money in the stock market. Have your dollar be more dollars in the future. Makes all kinds of sense. But in retirement, it's really much more about income, you know, as opposed to just growing your dollars. Now, when you're working, you know, during your working years, then yeah, you want to put money into various investments and you want it to grow, grow, grow. You're not really thinking about income per se. You're thinking about growing the amount of money that you have accumulating. But once you get to retirement, it's really much more about income. Not that saving money is not important. I'm not trying to say that. But it's really about, it's much more about income when you hit retirement. Because if you think about it this way, if you think, all right, I'm going to have this amount of money going out to cover my expenses, living expenses, discretionary expenses, I want to make sure I have enough income coming in to cover that. Or if I don't, which is permissible, I mean, you can obviously have more money going out than coming in, as long as you have the savings to cover that. Okay, so but again, you know, retirement planning to a large extent is really much more about income than it is about accumulating money. Okay, so that concludes the workshop. Any questions? You good? I see. Oh, yes.
You said one of your sources of income was other. What do you mean by that?
Oh, God. Well, you know, I kind of put that in as kind of a placeholder because, you know, some people might have, you know, some source of income. I mean, typically, you know, what I put down the annuities and the Social Security and the pensions and the, you know, distributions, you know, real estate. I put all that stuff in there. But there, you might have something, there might be something in particular. I mean, there could be money coming from a trust, for example, that sort of thing. So I just kind of put that in as a placeholder, just in case there's something else that I haven't accounted for. Yes?
Do you plan differently if your spouse is not retiring at the same time that you are?
Yeah, that actually happens a lot, where people will say, I'm going to retire, I'm not going to retire. So, or I have people that will sort of retire slowly, say, well, okay, I'm not going to just stop working, like one day I'm going to be getting a paycheck, next day I'm not going to be. Sometimes people will kind of, like I actually have one client right now, and she's phasing out. She's kind of went from like working like 50 hours a week, now I think she's down to 25 hours a week. And so she's kind of phasing herself out. So all of that does come into play when we build the income plan. And the way I work with people is we can actually segment the income into the different categories and project it based on time frames. So to answer your question, we can account for one spouse being completely retired, another spouse still working, and maybe that spouse is going to work another 5 years. Or maybe one spouse is going to go into part-time. So yes, we can account for that sort of thing. Yeah, and it's very common, in fact. Yeah, yeah.
And certain of our things, like if we don't start taking money out of certain things, like our IRAs and our 401ks, there's taxes and implications, right? So we have to start taking money from those, right?
Well, based on the current law, when you reach age 72, technically the year after you turn 72, you have to start taking what they call required minimum distributions from your deferred accounts, like a
72.
Well, based on current law, they actually, in theory, could go up to 75. There's a law that was passed in the Senate, but not the House. Who knows what the status of that whole thing is, right? But based on current rules, at age 72, you're now required to take out a certain amount of money. It's based on life expectancy. There's a formula that you follow. But yeah, I mean, if you have money in a tax-deferred account, the longer that goes, the more you're deferring the taxes for the future, which can be a good thing or maybe not as good a thing because, see, right now we're still within that what they call sort of the Trump tax law, the Tax Cuts and Jobs Act that was passed in 2017. That's expiring or sunsetting at the end of 2025. What's going to happen, right now we have that window where tax rates are lower, but after 2025 they're going to revert back to where they were, or most of them will revert back. And then in the future, I mean, what are tax rates going to do in the future? I mean, it's likely they're going to go higher. Now, nobody knows for sure, but if somebody asks me, to make a prediction, I'm going to say, yeah, tax rates are probably going to go up in the future. Now, what does that mean? When's the future? Well, we know based on current rules, they're absolutely going up in 2026. What happens beyond that, we don't know. But again, there are the required distributions starting at age 72. Yeah. Anything else? Yes.
Do you have any opinion about what we call precious metals? If you want to invest in those, like putting some money into a precious metal IRA or something like that?
Yeah, I mean, people ask me about precious metals, cryptocurrencies, that kind of thing. My opinion about that is that there's nothing wrong with diversifying some of your money into different asset classes. Commodities, like precious metals, in that commodities asset class. Yeah, I mean, I have no problem with people deciding to put some of their money in there. The real question is what percentage. Now, if somebody says, I'm going to put half my money into gold, I'm like, well, I mean, I get it, gold is one of those, it's a store of value, all that sort of thing. If somebody said, what percentage should you put in there, 5%, 10%, 20%, I get a lot of questions about cryptocurrency right now, and my response to that is extremely speculative. When you build a plan, there's money you can afford to lose, and there's money you can't afford to lose. the money that you cannot afford to lose is the money you need within your plan, you know, in order to make sure, okay, if I'm going to live till I think 95, I've got this amount of money, you know, I've got Social Security, maybe a pension, and then I've got a chunk of money, and I need X amount of dollars to make my plan work. But then I have a little extra money that maybe I, in theory, based on my plan, don't need, you know, then maybe some of that can be invested in some of these more speculative things. But be very cautious with those kind of, frankly, you have to be cautious with anything that you put your money into. Some things are, you know, more reliable, more sort of time-tested than other things. But yeah, there's nothing wrong with precious metals and that type of thing, you know, as long as it's properly allocated. Yeah. Any other questions? Yes.
There are so many types of people that I feel like I need to get either advice
Yeah.
or can one work with one person who has all the information they need to be their retirement advisor?
You know,
What are the categories?
well, let me say something about diversification, all right? It's important to be well diversified. You want to be diversified within your investments, you know, or among your investments, you know, stocks, you know, lots of different stocks within your portfolio, bonds, lots of different bonds. You also want to be diversified within, you know, among asset classes, you know, stocks, bank products, life insurance company products, real estate, you know, precious metals, commodities, you know, again, you know, be diversified among asset classes. It's also important to be diversified among advisors, because advisors are kind of like doctors, lawyers. Like, okay, so if you have a broken leg, you know, you don't go to a heart doctor, you know, sort of a thing. You know, if you, you know, need a will done, you don't go to a criminal lawyer, you know. You know, you identify what it is you need help with, and then you're going to go out and you're going to find, as a good consumer, you're going to find the advisor who is best suited to help you with what you're looking to accomplish. And so financial advisors are kind of like attorneys and doctors in that way. Some are more specialized than others, and those are questions you need to ask the advisor. What exactly do you do? Who is your best client? You know, who do you work with well? You know, ask those questions and be diversified. Nothing wrong with having multiple advisors. Nothing wrong at all. Okay, I'm a planner, and I have more of a holistic approach. I have my 6 steps process, 6 steps to retirement. If you go on my website, you can see it, you know, proincomeplan.com. I help people to develop a plan using what I refer to as a logical and sequential planning process. Logical in its approach, sequential in its execution. So I consider myself a holistic planner, but within that, you know, for example, I do a lot of investment management work, and I do a lot of Social Security work. By virtue of the number of years I've been doing this, I amassed a lot of different aspects of knowledge. But if people come to me and feel that they want additional assistance with, for example, if somebody says, I really want a lot more information on, you know, cryptocurrencies or precious metals, or certain types of commodities, you know, I'm going to say, not my thing. I don't excel in those areas. Dividend-paying securities, you know, I spend a great deal of time on those kinds of things. I do a lot with income-producing investments and you know, processes. So I'm an income planner. You know, I like to, and I do retirement transition planning on a holistic level.
Okay.
So okay, yep. Any other questions?
Thank you very much.
Thank you. No, I appreciate you coming. Thanks very much. Okay, great.